going on, everyone? Welcome back to the Capitalize Podcast. My name is Chris Casella, and as always, this episode is brought to you by our private lending company, Sharper Capital Partners. You can learn more about us and what we do at sharpercapitalpartners.com. Today, I have with me Rob Speckert. Rob is an investor and a realtor in the Cincinnati and Dayton, Ohio markets. And the way that Rob and I connected was actually pretty funny. I was just browsing LinkedIn one day, and I was looking up real estate professionals and real estate agents in my area, trying to network with people. And I came across Rob's profile, and it was decked out, and it was really nice, and it also had his contact info. And so I was pretty nervous at the time because I was kind of new to the space, but I gave Rob a call, and the thing that separated him from everybody else right off the bat was that he answered and that he was willing to give me the time of day and willing to chat. So we connected over lunch, and we've had a great relationship ever since. So I'm excited to have this conversation. Rob, thanks a lot for being here.
Oh, yeah. Thanks for having me.
So let's just start off real quick and kind of talk about you as an agent and as an investor. So what are your primary focus areas as an agent? Is it retail buyers? Is it investors? And what do you think kind of separates you as an agent from some of the others out there?
Okay, yeah. When I first started, it wasn't like this, but right now I'm 90% investors as my clients. And a lot of those are actually out of state as well. About 50% of those are out of state investors. And then about 10% I help homeowners that I know from my previous business that always call me up and want me to use me as my realtor, I guess. For my investors, I do single family homes all the way up to I sold a 30 unit just 12 months ago to a client as well. A lot of that bigger units are usually off market to my clients.
How are you getting connected with these out-of-state investors?
Through Bigger Pockets, actually. Bigger Pockets, people in Bigger Pockets usually find me on there, or just on Google search or LinkedIn, like you said. People that are looking to invest out of state. And Cincinnati and Dayton are great markets for out-of-state investors, actually.
Right. Yeah. Cincinnati, Dayton, and then I get a lot of people calling about Cleveland as well. Really good
Yes,
cash flowing
correct.
area up in
Yeah.
Cleveland. Similar to Dayton, I figure. So yeah, I hear great things about Bigger Pockets as well. And the more I hear about it, the more I'm like, okay, we should probably be pretty active on there. So that's great. And then how about as an investor, right? You're also a full-time investor. What's your primary focus area as an investor? Single family, multifamily?
Yeah. So we do both single family and multifamily. I think we have 8 single family homes right now. And then another 12 duplexes / fourplexes. So 2 to 4 units. And then single family units. We don't have anything more than 4 units. We like the BRRRR strategy, obviously. We rehab them, and then we refinance them, hoping to get all of our money back out or some more money as well. The last couple of deals kind of went over budget. We had some money left in the deal, but obviously the rental income will cover that over time. But I'm not afraid to leave money in a deal like some people.
What makes you like the residential 1 to 4 units as opposed to some of the larger multifamily stuff?
It's easier for us to buy, first of all, capitalize with our own money. Obviously, we have close to 40 units or whatever, but still, I mean, obviously, we don't have millions of dollars where we can just put money in and stuff like that. So I think the smaller deals are easier for us to manage and to do quicker as well. You know, we can turn a single family home, buy it, refinance it, and everything, rehab it, refinance it, all in 45 days. 50 days if everything goes right, you know.
Yeah.
Duplex in Norwood, my last duplex in Norwood, it took us only 3 months to do as a full rehab. Got a couple rooms and stuff like that. So, and that was from start to finish of rehab and refinance as well. So 3 months is pretty good. I couldn't do that with multi units, and then our money's tied up in something else.
Right. And that is one of the things that I do want to talk about in just a little bit is how you're financing your properties, and especially in this market. This is one thing I kind of touched on when we were on the phone yesterday is there's so much going on in the market, especially with banks and so on and so forth. We're recording this. Today is Friday, March 17th of 2023. And so we'll talk about that in just a little bit. But
Yeah.
you do have a great background, a background that I think is really interesting, and I'm honestly curious to learn a little bit more about it. So can you give us a little bit more of a background about who you are, how you ended up being a full-time agent and investor?
Yeah, so I actually owned pizza restaurants and pizza food trucks for about 22 years before I full time went into being a realtor in 2019. So from 1998 to 2019, I owned restaurants. And I was just investing part time. So back in 2004, we started flipping houses. And then we got in the rental business when the market crashed. So, and that's just how I did. I mean, the last, I guess there was a 10-year period where we didn't really buy a lot of real estate at the time because I was working the restaurants. But then once I sold the restaurants, I became a full-time realtor, and that gave me access to more of the market, and we expanded to more areas that I became more aware of.
What was the transition like? I mean, what going back to 2004? I mean, I'm curious actually, if we could just for a second, how did you get involved in the pizza business? Was it a family company?
Yeah,
Was it
actually,
something
no,
that you
it's actually I worked there when I was like 13 years old as a busser. And then I started managing the place when I was like 18 in college. And then I graduated. I didn't know what I wanted to do, but I liked the restaurant business. So my parents mortgaged their house to buy the business for me. And then I paid them back over time. And
you're
that's how
saying
we
that so
got it.
casually, but that's like I know that that must have been a big deal at the time, was it?
Absolutely, it was. It was a big deal, you know. There's a lot of work though too. So
Yeah. Yeah, absolutely. So how did you get into investing in 2004? You know, how did you come
um,
across your first deal? What made you get involved in real estate?
yeah, so our first deal, we actually bought it at a share sale, sight unseen. We just drove by. It was in Mason School District. We knew Mason, obviously. It's very high even back then, back in 2004. Very sought after. Just a three-bedroom, one bath ranch, 1,000 square feet. Me and my dad each took like money out of our home equity lines and bought it with cash. We rehabbed all of it ourselves. We did all the work ourselves. Made like I think it was $15,000 or something off the property in a matter of like 90 days or something. So we put that money in a bank account, and then we started buying more at the sheriff's auctions before people knew about sheriff's auctions and stuff like that. So that's how we got started in real estate. We just thought we could do buy real estate and just flip it, and then that's how we started. You know.
Yeah, I mean, and I think starting at a sheriff sale, you know, sheriff sales are considered maybe a little bit more complex for investors nowadays. It's like there's a lot of different details, there's some red tape. You have to kind of know what you're doing. At least people feel that way. You have to know what you're doing because, like you said, you are getting the property most of the time sight unseen. How did you feel comfortable going into that? And did you have contractor experience in the past? Like, how were you able to do a deal like this for your first time?
Well, we're handy people, so I mean we could fix our own stuff like that. We've always been me and my dad. So, and that's just I mean we took the risk. I'm a risk taker, so I like taking risk. I mean that's why I still buy properties. I mean hell, that's why I went in the restaurant business because I was a risk taker. You got to be risky to do that. So,
That's a good point. That's fair. Okay, so can you talk us through a little bit of the details? I know you said you made about $15,000, which is a great first deal, I must say. How did you? You said you got a HELOC on your property with your dad. That's how you financed it. What do the numbers look like? How much did you
yeah,
buy it for?
so
How much did you put into it and sell it for?
okay, awesome. So yeah, I got a HELOC for like 75. He got a HELOC for like 90. We each put 50-50 in it. So we had some money for fix ups. I believe we bought it for like 70. If I remember correctly, like 70, 75. Put like 10, 15 into it and then sold it for like 115 at the time, 110. If those numbers are correct. It sounds like they are. We sold it by ourselves. We didn't have a realtor or anything like that. Um, so we were able to do that without a realtor, which was great at the time. I would never do that now because I'm a realtor. I understand how important they are.
Yeah,
But I
saved you
did
some
it at the time.
fees
I
though
probably
for
could
the
have got
first
more
deal.
money using a realtor, obviously, but I didn't. We didn't.
Yeah,
Um, but I think that's what it was, you know. I mean, we did make a couple mistakes in that property. It had a crawl space, and there was an oil tank down there. But we finished the rehab, and then we realized there was an oil tank underneath the house. This is our first one, so we didn't really know what we were doing that much, right? So, um, but what we should have done was when we gutted the bathroom, we should have cut the floor out too and removed that oil tank because we
yeah.
had to
So I
pay.
mean, for there probably are a lot of newer investors who are listening. Why is finding an oil tank a big deal? Why should you have done things differently?
Yeah, because the oil tank was rusted and leaking. So obviously it was an old oil tank, but it still had oil in it. So I had to pay someone to go in there and cut it all up into pieces, drag it out, clean up the oil, and then put a vapor barrier down in the crawl space. But I didn't really know about crawl spaces back then. So I didn't know how to fix those things.
Right.
But obviously now I do. Uh,
Right. So what's the worst case scenario again for people who are listening? What's the worst case scenario? You find an oil tank down there, it's leaking. What's the worst case scenario if you don't address that problem sooner rather than later?
I mean, obviously the house smelled of oil once it started leaking. So
Yeah.
we had a brand new rehab. refinished floors, fresh paint, new bathroom, new kitchen, and it smelled like oil until we were able to get it all out of there. And that was the worst part about it. Obviously, the first buyer had an inspection, and that's what the first thing came up. Um, so, but yeah, that's what happened.
Yep. Okay, so I mean, it sounds like honestly, it sounds like a great first deal, and I think one of the things that stands out there is that, like you said, you took the risk and you really did just go out there and make it happen, right? You did your own rehab. I'm sure. I mean, how do you feel like? Do you feel like the $15,000 that you made on that first deal was more valuable, or do you feel like the experience of going through that process was more valuable?
Oh, the experience for sure. I mean, all the money we've made over the years. I mean, experience is the big thing. I still learn things on every project still, and
Yeah.
we've probably done close to 100. And I still learn things.
Yeah, I hear a lot, and I mean, I see it in my own life and in our own business. Really, the first project or the first whatever it is that you're doing is normally the hardest, but it kind of snowballs after that. And so I
Hmm.
like to ask that question because $15,000, I mean, especially for people who are new, that sounds great. For people who are not new, I mean, it sounds pretty
Yeah,
good. So
yeah,
um, hearing that the experience was more valuable, I just kind of think shed some light on the fact that
yeah.
getting started is really the most important part.
Hmm.
So between 2004 and 2008, because I do want to talk about what it was like investing during that time, during the crash. But between 2004 and 2008, did you do any other projects in between that time? Where you did you take a step back, or what did that time frame look
Yeah,
like for you?
we actually after we did that one, we continued to flip houses. We found a local bank, Spring Valley Bank. I'm sure you know them. They do fix and flip loans. They were doing a lot of them back then. They were like the pioneer for like hard money lenders, technically in this area. And They did fix and flip loans, 18 months, interest only. And we met with them. We told them what we did in the first project. We told them who we were, and they gave us like a credit line of like $1 million just to go out and buy like properties, right, at these sheriff sales and whatever. So we would bid on them at the sheriff sales. We'd get them, and then we would go to the bank and be like, "Hey, we need a loan on this one," and they would have the loan ready when the deed was ready at the county, and then we flip it, and then we'd pay them back, obviously, and sell it. And back then, it was 9.5% interest or 9.25% interest only loans. It was only like $1,800 for I think processing fee or something like that, 1250 for a processing fee. But it was 18 months interest only loans on
Yeah,
those.
yeah,
And
that's
we just
great.
continued to grow, and we did multiples of those. Multiples.
At the same time,
At the same time, yes, correct.
were you still? So I have a couple questions here. This is going to be asking a lot of you, but if you could bear with me here, I think this is really, really valuable stuff. So you're talking about a line of credit from Spring Valley Bank to go and basically bid on these sheriff sales. Can
Hmm.
you kind of walk us through? It can be high level or as detailed as you like. The more detailed, the better. But can you kind of walk us through that process of what that looks like to utilize a line of credit from a bank and
Yeah.
to have that money available for the sheriff sale?
And it wasn't like technically a line of credit. I guess I said it wrong, but it was like just saying, hey, they would loan us up to $1 million on property, right? Once we saw it. Obviously, each loans were individual to the properties, but they would loan up to $1 million for us. Um, and when we started doing that, we used our home equity lines to fund the projects. So we never used their money to rehab. So we never took rehab money out. We just had the base money in the deal. So when we did that, it kind of like when we sold it, obviously we were able to pay off them, and then we were obviously pay off our home equity lines, and then sometimes more, obviously, usually because we were always carrying to the next project, obviously, too, as we were growing. So we were always had a balance carrying there. But we would pay each loan off with Spring Valley. And obviously that gave us a lot of confidence in buying, right? So if you didn't have that, I mean, even now, a lot of investors don't have that confidence in buying. They got to buy it and then go find a bank to do it. This bank had already given us permission to keep on doing it, which was huge
Right.
for us.
Right. And that's one of the things. I mean, it is kind of hard to find financing, a lender who's willing to basically approve a loan when you can't get in there and see the property. And, you have the right of redemption period. You have a few other moving pieces with sheriff
Mm-hmm.
sales that make the lending process or the capital stack as the investor maybe a little bit more complicated. That's why I figured it'd be valuable to kind of walk through that process.
I think obviously we didn't have the experience at the time, but I think we had enough backup capital that they knew that we were safe people to lend to, I guess.
Right. Right.
I think that was really the key. I think now a lot of lenders like the experience. Like obviously I think you would loan me on something if I found something and I said, "Hey, Chris, I need money." You'd be like, "Okay, Rob, here it is," you know. So, but
Yeah.
like that's obviously based on experience, though. But yeah,
Right. Yeah, the relationship that we built up and knowing,
that's
yeah,
correct.
exactly. Right. Okay, so 2004 you're getting, you're basically utilizing the funding from Spring Valley, you're flipping properties. So what happens as '08 comes along and the market
Yeah.
shifts, right? You're already buying from share of sales, and if I remember correctly, the largest number of foreclosures in the past, I don't even know, maybe 50 years was in 2010. There was about a million foreclosures in the year 2010. So you were kind of ahead of the game in that area, buying from sheriff's sale, kind of maybe short sales and stuff like that. What did your portfolio or your strategy look like as you entered 2008 and you kind of went into the recession?
Yeah, so that kind of hurt us, obviously. I think it was like 2009 is when we started getting hurt the worst. We had like five single family homes that we couldn't sell. They were on the market. My dad had became
Flips.
a real, yeah, flips, and we were just flipping them. My dad had became a realtor. I mean, the market dried up with mortgage. People couldn't buy them. So we had five houses, and we were losing like, I think it was close to 10K a month of our profits that we built up over the years. And after like the third month, we were like, "What's going on? What are we going to do?" And I knew some buddies that were actually giving them back to the bank at that time, giving properties back to the banks. But we decided to put for rent sign. We pulled them off the market, put for rent signs in our single family homes that we were going to flip, and we rented the properties. We were able to pay the interest only loans on them for a couple months. We went to another bank and said, "Hey, can we get loans on all these properties?" And they were able to do that. And as of today, I still have three of those properties still today that we were going to flip, but we had to put a tenant in there. And two of those had the same tenant in there since then.
Wow, that's great.
So it
So just
obviously
kind of,
worked out good.
yeah, right. So just kind of taking a step back here to kind of follow along. So you have these properties that you intended on flipping. You had done the rehab. You had bought them maybe from sheriff's sale or maybe from some other method, and now they're on the market and they can't sell because obviously you're in a financial crisis during '07, '08, '09, and mortgage lending has become much more difficult. It's much more difficult to get a loan for these retail buyers who would be buying those properties that you have on the market. And when you say you're losing 10K a month, just to clarify, you're losing 10K a month because you're paying these essentially hard money loans to the bank to hold on to these properties, but you can't find a buyer for them.
Yeah.
So your strategy there and the solution was, okay, well, let's kind of mitigate this hemorrhaging and put in a tenant to pay the monthly rent, and then to be clear, you went to a different bank to get a refinance out of the hard money loan and pay maybe a 30-year fixed rate conventional, which is going to be at a much lower rate.
Yes, correct. I knew a buddy that worked at a mortgage brokerage, so he was able to give us loans, and all these.
Okay, awesome. Yeah, I think that's great. So, okay, so you had those three rentals that you still have today. Did you completely switch your strategy and say, "Hey, maybe we should just build our portfolio rather than doing flips," or what did you kind of do after you made that decision?
Yeah, so when we knew we were kind of in trouble, the mortgage crisis in trouble, we stopped buying, right? Obviously, because we didn't know what was going on. We didn't have the capital to keep on rehabbing these buildings because we had already dried up our credit lines because we had five houses to sell still. So we obviously stopped buying at the time. So when we went to rent them, we actually got our money back and got some more money, and we actually bought a 30-unit complex in Deer Park at that time for a really good deal. So we were able to do that. So we just switched our mind to like just rentals, right? There was a 10-year drought there where we didn't really buy anything. Um, and then when I became a realtor, like I said, in 2019, um, we started buying again. And we flipped a couple to start off again. And then we went back into the burr strategy right away because we felt like that was going to be the biggest gain of wealth, after we
Okay.
flipped a couple and bought a couple rentals with that money.
Okay, great. Yeah, so just to clarify for anybody listening, we've mentioned a couple of neighborhoods. We've mentioned Norwood, we've mentioned Mason, and we've mentioned Deer Park. And so for anybody who's unfamiliar, these are suburbs of Cincinnati, Ohio. Um, and so the 10-year drought, of your buying period, did that start so that was 2009 to 2019,
About then, yeah, yeah, correct.
roughly?
Yeah,
roughly?
roughly. Yeah.
Okay. And you had a portfolio already, though. During that 10-year period, you're still kind of servicing an existing portfolio. You have a 30 unit and maybe a handful of other rentals. Is that correct?
Yes, correct. At that time, yes.
Are you self-managing these properties or are you
I
hiring that
was,
out?
yeah, I was self-managing the properties while I was running the restaurants without tenant software, all on spreadsheets, which was a nightmare, right? But it's what we had to do, to keep it going. And obviously, there wasn't software back then that there is today either. So, like back in 2000, there wasn't like, or I guess 2000, 2008, 2009, there wasn't like tenant software as depth it is now. We use Tenant Cloud right now, and it's very affordable, and it helps me tremendously to manage all of our rentals.
What would you say if you think back to that period during the recession? What aside from rentals are very valuable and that's a good strategy. What would you say is your biggest lesson that you learned that you've carried with you today? Again, aside from that strategy switch from flipping to buying rentals.
I think we just have more confidence um, as a company and me, like just to like there's multiple exit strategies to every property I believe in. As long as you don't make too big of a mistake buying it, you can always sell it. You can always hold it longer. You can always obviously maybe lose a couple $100 or $100 a month on that property. But if you had another property, it could supplement that. That's what happened to us at the beginning when we refinanced those properties. There was one or two properties that were losing like $100 a month if you divide them up. But overall, we were making money.
As a
So,
portfolio.
yes, as a portfolio, and I think that's really the biggest thing. And I also got used to like being in this market for so long. I've also understand that like interest rates aren't the deal of I guess I can't, it's hard to say like the king of everything, right? Interest rates aren't the king of everything, and that's what people still believe today that are getting in the market. I mean, obviously interest rates are high right now, but they're not like super high. Um, I mean, I think super high is like 9, 10%, right? But in average, I mean, I was buying houses back in the day for 7% all day long. I mean, obviously prices are more expensive right now, but rents are also up. So that kind of bridges that gap between interest rates and prices. So I guess what I'm saying is don't be afraid to buy something just because the interest rates are like higher right now. You can always refinance later. You're never married to the interest rate. You can always just refinance at any time.
Yeah, I think that's a great point because, I mean, some people might be tired of hearing this, but I think it's such an important reference point. You think back to like the 80s and interest rates are 15%. You hear these stories, at least I do from some of the people who've been in the game for a really long time, and they're like 6% is scaring people, from the market, but they were basically getting free money before. When you think about an interest rate at lower than 3% at its lowest point, it's basically unheard of throughout history, at least since the Fed has been around. So I
And
think
we
that's a
may
really
never see
important
that
point.
rate again. We may never see 3% again in our lifetime. And I think when the interest rates do go back down, it'll be around 5%, 4%. But I don't think they're going to go as low as 3% ever again in our
What
lifetime.
what makes you say that?
I just think it's free money, like you said. I don't see why they would do that. I mean, why would the interest rate be that low? I don't understand why would the Feds would even consider that. I think at a 4 to 5% level, the prices don't increase as fast in the housing market. I feel like we have a housing shortage of houses. We have a
Yeah.
shortage of houses. That's why rates are going skyrocket. That's why no one wants to put their house up on the market because they're afraid they're going to go see and not find another one. I mean, there's some scare tactics there that they've created since that 3% interest rate, which I believe. I mean, obviously, it's just my opinion, but
Yeah. No, I think we're seeing similar things. I think there's no question there's a housing shortage. And I think that's one of the reasons why, the prices, although there's been such a large rise in interest rates, some of the prices haven't fallen, at least in our region where we are kind of the Midwest, the Rust Belt, haven't fallen in proportion to the rise in interest rates.
yeah, I haven't seen that either. I mean, there's some parts that have, but yeah, I agree. It hasn't affected at all.
Yeah. Do you see any similarities where we are today, or maybe in the years 2022, 21, and 2022? You see any similarities between that period and the run up to the financial crisis in '08?
Um, I don't necessarily, there's some similarities to it, like meaning that like there has been a huge rush of investors trying to come into the market right now. And that's what happened back in 2007 when we were in the market. Everyone wanted to be like, hey, what do you do? How'd you get that house? Or can I go to the share of sales with you? But like there's even more people now doing that stuff. But I also think the reason why it collapsed last time, obviously, we know that it's because of the mortgage crisis. They've obviously tightened up lending, and I don't think that'll ever happen again unless they loosen lending practices again, or unless they give out bad mortgages. That would be the only way that I think that could happen that drastically.
Okay. Okay. Yeah. So I want to shift gears just a little bit and talk about some of the more creative deals that you might have done. So, like you said, there's a lot of different ways to exit properties. There's a lot of different ways to take deals down. You mentioned one of the biggest mistakes on your first project, but what's the most creative way in your memory that you've taken a deal down that most people might not think about or might not know is even possible?
Um, Obviously, I have a lot of investor clients. Okay. And a lot of investor clients trust me after I do the first deal with them and stuff like that. They understand my work ethic and all that stuff. I had an investor with a lot of money. He's local to Cincinnati. He bought three properties, one off the market I found and two on the MLS from me. We rented all three of them. And he owns a pretty big company. And him and his wife he had a dream, or his wife had a dream. The third month they were in, after the first three houses were built and rented, or I'm sorry, bought and rented, they called me up the next morning like, Rob, we want to sell these. And I said, what do you mean you want to sell them? I was like, you're making money off of them. We just got great deals on all these. And he's like, the guy says to me, I'm afraid to get sued by a tenant. I had a nightmare last night that I got sued. And he's like, I had an ex-employee sue me and it was a nightmare 10 years ago. And I just had the same actually dream about it. He's like, I need to sell them. So he's like, but I would be interested in selling to someone as owner financing so I can still get passive income. So literally he named the price on each of them. It was like $10,000 more each house that he had put in. I bought all three of them from him, 100% owner financing, at 6% interest for 15 years on all three of them. So obviously that was probably one of the best deals I've ever gotten because I had to put no money out of pocket. But he's extremely happy. He still gets his money each month. He doesn't deal with any calls, and he knows I'm going to pay him. He knows me. He's not like I'm not going to pay him.
Right.
And then he'll probably get his money in 5 years because we always refinance our properties about every 5 years just to get more money out or whatever.
Right.
Lower rates.
So 100% owner financing, for anybody who might not know, that essentially means that the seller, in this case, Rob's client, is acting as the bank and is basically giving Rob a loan to take these properties from him. And so 100% means that Rob didn't come out with a down payment. He basically is just getting handed these properties. And I guess, Rob, a question I have is, were the rents from the property covering the mortgage that you were paying? And were you
Yes.
cash flowing on these properties?
Yeah, we cash flow right now on the properties. And it just happened like 3 months ago.
Oh, that just happened.
Yeah, three
That's
months.
awesome. So three properties, no money down, and immediately you're cash flowing.
It was literally like I was like, okay, I'll buy them. And when he said he wanted to finance them, I said, "Would you do 100?" He's like, "You want to do 100%?" He's like, "Yeah, I would to the right person." I was like, "Well, I'll do it." He's like, "Oh, I'd love to do it for you or with you." So I said, "Okay."
That's amazing. That's one of the better
Making my
deals that I've ever heard of.
Yeah, it was actually just being at the right place at the right time.
Right.
But I think that's all to do with like your connections, right? Like you and I became somewhat close friends, sometimes now. So like you call me up for things, I've called you up for things. I just think meeting people is what's driven my business to where it's at though. And I'm saying same with you.
Yeah. And I think treating people right, like treating them like humans, I think it's so often in business you can kind of make it transactional, right? You do this, you scratch my back, I scratch yours. And maybe that's how it ends up working, but approaching it that way I think is the wrong way to do it. So, we get lunch, we had a great conversation, and now when we call each other, I mean, I never expect anything in return. I'm always trying to make sure you're taken care of if you help me out, so on and so forth. So I totally agree. And I think in my mind, there's no There's no question why that investor wanted to do that deal with you, because if I were him, I'd want to do that deal with you too, just knowing that you're trustworthy and knowing that you know your stuff.
I mean, that's why, like, he also now has offered us our flip money now. So like he wants to put more money in real estate, but he doesn't want to buy it, right? So now he wants to just be our money guy. So he's like, I'll give you money for your next flip. You just pay me back after you refinance it or sell it. I mean, what kind of deal is that like to get? Like that's incredible. I pay
Right.
no points. I pay an interest rate at the end of the deal. Like that's just insane.
For sure. But with the right client, I mean, again, like I'll come from a hard money perspective. One of the
Hmm.
reasons why we don't do that is because we're lending at scale, and
Hmm.
the higher volume makes it, if we were to do that and we were to offer a client to pay us back only at the end of the term, we would not know in the event that they were defaulting or they weren't able to make payments until the very end of the deal, which is, for all intents and purposes, too late, right?
Yes.
But in this case, I mean, I feel like if he trusts you and he knows your background and he knows that you're going to get him paid back, it makes perfect sense.
Yeah, it's basically his way of partnering with me, basically. Instead of me giving him ownership, I'm paying him interest. And he can't make that money anywhere else.
Secured by a loan or secured
Yeah,
by a property,
yeah, he
right?
get
With
first
that
lien, yeah,
safety.
correct. Yeah, I mean
Right.
that's safety. He can't at 10% a month on his 100K, that quickly. I mean that's in 3-4 months. I mean
It's a great return. And I think that's one of the great things about real estate, especially from a lending perspective, is that you're secured by the collateral itself. And so you know that in the worst case scenario, you have an asset that you can take back and sell. Maybe as long as you're underwriting the properties and you're underwriting the deals correctly, then you're pretty safe. So that's great.
correct.
So that's one of the best deals that you've done. Can you tell us about one of the worst deals that you've done?
Yeah, one of the worst deals I've done. I mean, it's not even that bad of a deal. But I've never lost money on real estate deal, but like there was we bought two duplexes on the same parcel up on Dayton in Dayton, okay? Two buildings on the same parcel in Dayton. And we went to do an appraisal. Obviously, they do it on as a four family instead of two families because it's on the same parcel. So a four family appraises for less up in Dayton right now in certain areas than two duplexes do. So we kind of lost like $75,000 in ARV there during that project from start to finish. So we had to leave close to $75,000 in the deal as well. I feel like that's probably my biggest loss I've ever taken, just because I had to leave more money in the deal. I mean, I don't know if it's a loss, it's just a bad, one of my worst deals because of that, because I had to leave the money in the deal. Now, obviously, my mortgage payment's a lot less, and we're cash flowing a lot more on that property than we thought we were going to. So, in the scheme of things, is it really a bad deal? I don't. It's not going to be, but at the time it was because I had to wait to get that 75K back.
Can you explain what you mean when you say you had to leave $75,000 in the deal? Can you just explain how that kind of works out and what you would have preferred to have had happen?
Yeah, in simple terms, like if it's $100,000 ARV or refinance, we use DSCR loans when we refinance out of hard money lenders like you guys. We use DSCR loans. They give us 70% of value. So we have $100,000 ARV with appraisal. My loan guy on my 30-year fixed DSCR loan will give me $70,000. If my rehab budget was like, if my rehab all-in purchase was like 90,000 on that project, I would have to leave 20,000 in the deal. That means I'm not getting my full capital back after purchase and rehab.
That's really helpful. I appreciate that. And we have a whole, for anybody listening, we have a whole podcast that I did with Chris Fleming from KFP Investors about DSCR loans, debt service coverage ratio. If you have questions about that, you can go back and listen to that episode. It was just a few episodes ago, but that sheds a lot of light. I think that's really helpful. I appreciate that, Robin, because that's the goal, right? You brought up earlier that you typically refinance your properties every, so many number of years. And really, if I'm thinking about it correctly, the reason for that is because you want to cash out, meaning get some of your equity out of those properties to put into future deals and expand your portfolio.
Yes, correct. Or sometimes even lower the interest rate. Like right now, all the properties we've done I think we did 6 or 7 of them last year that we refinanced. I'm sorry, bought and then refinanced. So those seven that we did, we're going to want to refinance those because those are at like 7 point something percent interest rates right now. In a couple of years, when I can get them at 5% at a lower ARV, even or I'm sorry, higher ARV, lower LTV, loan to value. I mean, my interest rate's going to go down even more. My payments are going to go down more. Now, obviously, if I need money, we can take money out of those as well. But a lot of times, we just refinance them to get the lower payment. Usually, that's what we do.
Okay, awesome. And I think to your point, the worst deal that you've ever done just meant that you had to leave more money in the property, but it cash flowed a little bit more. I think that's the best worst deal that I've ever heard.
I know, right?
Yeah.
I tell you that all the time. Like I really think it's really hard to lose in real estate. To be honest, I really do. I really do.
And I think in what way?
I just think not keeping it long enough, even if you're in a bad deal, if you keep it long enough, you're going to make money.
You don't realize those
Yeah,
potential
exactly.
losses.
Correct. Yeah, correct. You know, I feel like sometimes, people don't buy deals too because they don't have access to hard money lenders like you guys, I think a lot of people don't understand how easy to do a deal is with the hard money lender. And some people think it's like not a good thing, but actually it's a really good thing to use you guys. So I think
Yeah.
that's a really good key that stops people as well, not using hard money lenders.
I appreciate you saying that. And I think before we got involved in real estate and really fully understood what hard money was, it did have kind of a negative connotation around it. And so one of the reasons that we got so excited about the business was as we learned more, we saw the potential for it to help investors like yourself and others scale their portfolio and get deals that they might not have access to otherwise because of the quick, closing timeline and so on and so forth. So I certainly agree. And that's one of the, again, another reason why we're kind of doing this podcast and writing articles on our website is to try to help educate people about exactly that.
Yeah.
So I do have a few other questions, but I'm curious what your experience was like during COVID, and we can just touch on that quickly as we kind of, near the end of the conversation. What your experience was like during COVID, and then I'd like to transition to talk about what your goal is or what your goals are for the future.
Yeah. So COVID, we the biggest thing we found out is we put all of our tenants on month-to-month leases during COVID. So if we had a vacant unit, we were moving someone in, we would put them on a month-to-month lease because if they came back and told us they lost their job with COVID and the county wasn't eviction because of that, we could at least send them a non-renewal notice and tell them to get out still, and we were able to take back our property. Obviously, you never want to put someone out of your property, but obviously this is a business and you need the cash flow to pay your mortgages. So that was our way of controlling the situation with tenants, is to put people in month-to-month leases. I still have clients that only do month-to-month leases because of that, because you can get rid of the tenant at any time. A year lease kind of like strongholds the landlord to keeping that tenant. And so that's why we did the month-to-month during COVID. But we were able to evict at least one person during COVID and inside Hamilton County too. So that didn't stop anything. He just didn't fill out the COVID paperwork properly, and he said he didn't try to find a job. They had to try to find jobs. They had to show proof they were trying to find jobs, but he wasn't able to do that. So obviously he was lying.
Mm.
But
So I kind of see the month to month leases as kind of a double-edged sword because on one hand you want the security of having somebody in there and not risking vacancy. How have you seen that play out? Have you gone back to the year-long leases now, or have you stuck with month to month?
actually, I've just signed a month to month 2 months ago with someone, but I just recently started the year leases, just right back last month, just because we're getting at a number of units that I don't want to have empties, so I'd rather lock people in.
Right.
Um, but I mean, month to month doesn't scare me at all. I rented an apartment actually this past week for month to month. I just charged her $30 extra per month. Um, so I got 930 instead of 900 a month. I mean, that's actually a cheap increase for a month to month, but they asked me how much more it was, so obviously I gave them the price.
Yeah, I mean, I remember signing a lease when I lived in Greenville, South Carolina for a little bit. I remember signing a lease, and to go from a year-long lease to a 6-month lease was $100 more per month. So
Yeah,
I think
yeah.
that's generous for sure. But if you feel confident, in your case, if you feel confident in your properties and your ability to find somebody else to take that lease on, then I can see why you wouldn't be, necessarily afraid of month to month.
Yeah, I'm definitely not afraid of it. I mean, like I said, I still have clients that do it. I think if you keep your properties nice, and you know how to advertise your properties when they're empty, you don't have problems renting them.
Yeah. And so, last piece on COVID, were you still buying during COVID, or did you put a pause on things?
No, we didn't put a pause on anything. We kept on buying. We did actually a lot of our flips during COVID. Um, we flipped a couple condos during that time and stuff when things were shut down.
And so obviously, or maybe not so obviously for some people, but you got great prices on the end of that, right? You're probably looking at great ARVs. You might have still bought more. Were they more expensive to buy as well?
Yeah, they were still expensive to buy, but we still got good ARVs. We still made great money on those.
Did you buy any properties during COVID at kind of what I would imagine now is going to be the price ceiling that you still have today that you're a little bit worried about regarding the price corrections?
No, I don't think there's going to be a price correction, but I mean, I just don't think there is going to be. As like I said, I think there's a shortage,
Because of the
of
inventory? Yeah.
yeah, there's not enough inventory. The only way you could have a correction if you have excess of inventory. You still don't. So I mean, we're still like very short on inventory.
Yeah.
So I don't think that's going to happen. But um, I mean, I bought a single family home in Oxford, Ohio. I think I told you about that when last time I talked to you or something. It was this student rental at Miami University. I thought I overpaid for that one because it's for my daughter and her friends. I bought it for 305. I rehabbed it. This was this past December. Rehabbed it, and then it just got appraised last month for 380 after I only put 30 40 in it. So I mean, that was the deal that I thought I was going to leave even more money in, but obviously it didn't.
Yeah. No, we did talk about that one, but I didn't know that it appraised last month for 380.
It's
That's great.
380.
That's great.
It's
That's
on
great.
campus though, so I mean, you can't ask for better location.
Student rentals, yeah, and I think especially in Miami, student rentals are just that's a whole different game.
Yeah, they're expensive.
Right, for sure. All right, well, I think that kind of covers it for COVID. So what do you have coming up next? What are some of your goals moving into the future? And are you just looking to expand your rental portfolio? Are you looking to get into bigger multifamily stuff? What do you have going on in the future?
Yeah, I mean, I think our biggest concentration is just smaller multifamilies. I'd like to do some more like minor cosmetic stuff because we've been doing some big projects lately. I'd like to find my next one is a couple small ones, a couple small minor ones that we can do to keep our guys even happier. But yeah, we're always looking to buy. We made a couple offers last week on things. We just haven't gotten anything under contract yet, but we're obviously always looking to buy single family. Obviously, multifamily 2 to 4 is our sweet spot. But if there's bigger units out there that we think the numbers work good for us, then we would do it. But I have no plans directly right now to go find that. I sell more of those than I buy of those bigger units.
Do you still have your 30 unit in Deer Park?
I know I sold that back in like 2015 or something like that.
Okay. And one thing that I should have asked in the beginning, so I apologize to anybody listening if you've been wondering this, but Rob, what does your team look like on the investment side?
It's me, my brother, and my dad. Um, Me and my dad just started the business, and then my brother just joined in 2019 when we restarted back up. We actually started because he wanted to get involved, and he's like, "Hey, I want to put some money in this thing, and I want to start buying properties too," because he saw what we were doing, how much equity we had in our first like 10 or whatever we had. Because obviously the ones we bought back in 2004 that we still have, and then we bought through that 2010. I mean, we have tons of equity in those, obviously.
Right. Yeah, he saw that the worst deal that you've ever done was one that still cash flowed and even more than you expected, and he was like, "All right, I got to be a part of this."
Yes, correct. Yeah, yeah, and yeah. He gave us the money. Obviously he's kind of hands off. My dad's more the like accounting type guy, but I'm the one that's like controls everything, the deals and stuff like that. Obviously, like if I say let's do this and they look at it, I mean, obviously they're going to trust me to do it.
Hmm.
But some of the properties they haven't even visited that we've bought over the last 2 years, they still haven't gone to see them, and they live in town. So
And so you self-manage, right? You're still
that's correct. I'm
self-managing.
sorry. Yeah.
No, that's okay. So there's no property management. What about your team for fixing these properties up? Do you have your own GC in-house? Do you have your own? How does that kind of work?
Yeah, I do everything. I control all the contractors myself. I have two separate contractors that like do full rehabs for me. I'll call them when I have deals. One of them works pretty much full time for me at all time. The other one works a lot with me, but then also my girlfriend actually runs a division inside our brokerage office where we rehab houses for out of state investors, or we'll rehab a bathroom for out of state investors that have duplexes or rentals, multifamily units, and then she oversees those projects and takes a small cut out of that. So we put those guys on that division when I don't have stuff as well. But yeah, those are the two sets of contractors we have. Plus, I have like three handymen I use as well in certain things, but they also service other customers as well. But those are guys that I've known for years and years as well.
Okay, awesome. And do you have anybody in house doing marketing, or like you said, you handle all the deals? You handle finding the off market stuff, finding stuff on the MLS. Is that's all you?
Yeah, that's all me. I mean, obviously, I get a lot of emails with wholesalers and stuff like that. And wholesalers, a lot of them aren't.
Yeah,
The ARVs are wrong, or the purchase price is way off, or the rehab's
right.
way off. But I sort through them every day when I get them. I get wholesale deals every week. Sometimes I pass them up to my clients, but 90% of them aren't good deals anyway, so it doesn't mean anything.
Okay, awesome. Yeah, I appreciate you running through that. Like I said, I should have asked that question towards the beginning, but as we kind of wrap up here, I just have a few final questions for you. And this one's more general, but what's your favorite thing about real estate investing, and or what's your favorite thing about being an agent? Maybe those two things are the same.
I think we'll start with the agent first. I think me just helping people with my knowledge of things is what I like to do. I feel like I could quit being a realtor and concentrate on my rentals and start taking cash from that. But I feel like I really enjoy helping people do what I've been doing. I have a couple clients that just started with me back in 2019. They're still with me, obviously now, and they've grown from zero numbers to like up to like 40 in a matter of like 3, 4 years. And I've just taught things that I've done, that I've taught them lessons that I've learned that I shouldn't have done and stuff like that. And I feel like I really love helping people do the same thing that I do, and I just enjoy it. Um,
Yeah.
I think me analyzing numbers and stuff like that is one of the funnest things to do in the real estate. Just looking at properties and be like, okay, how can I make money off this? I think that I love doing that for the investing side. I'll always look at properties, even if I think the numbers don't work. If they're in my areas that I really like to buy, I'll definitely go see them just to make sure there's no hidden things that I can like actually make money off of.
Yeah, that's good to know that you enjoy doing that, because I know I call you a fair amount to have you do that exact thing. So I appreciate that.
Yeah, no
And
problem.
what about the investing thing? Okay, that's what you're saying. You like looking at the numbers and
Yeah,
seeing the
yeah. I just like looking at the
opportunities.
numbers. I love looking at the project. Like what can I do here to maximize my dollars? What's going to be our exit strategies?
Yeah,
And that's what I love about real estate investing. There's so many exit strategies, like we talked about. And now with midterm, rentals and short term rentals. I mean, you could have buy a single family home. You could do long term first. You could do short term first. You could do midterm. You could flip it and sell it. I mean, or if you were going to flip it and you put too much money in, then you could long term rent it and then sell it later on. I mean, there's so many exit strategies.
right. So today, how can people add value to you? Is there anything that you or your team could use from somebody who's listening who wanted to reach out and say, "Hey, I can help you with that"?
Yeah, absolutely. More deals, obviously, always. That's the number one everyone's going to say, right?
Yep.
More deals, more deals, more deals. No, I mean, I think I like connecting with people. So if anyone has questions, they can reach out to me. I can tell them a little bit more about details or whatever. But yeah, I mean, just anything. I'm always willing to learn from people. That's why I met up with you the first time. I'm always looking to network with people inside of real estate and investing and stuff. I think that's the biggest thing.
That's a perfect segue. So how can people, if people want to reach out, how can people get in touch with you?
They can shoot me a text 513-478-7599. They can find me on Facebook, Robert Speckert. They can go to my website as well. And that's on my Facebook page as well. But yeah, I mean they could email me. I don't know if you can put my email on the thing or whatever, but it's cincyapartments@gmail.com. CINCY apartments at gmail.com.
Awesome. Yeah, and I'll put all that contact info down below so that people can have it at their disposal. Well,
Yeah.
Rob, I really appreciate the time. It's always great chatting with you, and I look forward to continuing to do business with you. And hopefully, some people reach out, because I think it'd be in their best interest to do so if they wanted to learn a little bit more about real estate or just get connected and have a conversation. So really appreciate your time.
Awesome, man. Thank you.
Awesome. Thanks, everyone. We'll see you in the next one.